Good afternoon. Hello, everybody, and welcome to the fifth webinar in the series TI Talks Global Trade and Logistics with Absolute Strategy Research. My name is Lisa Moore, and I'll be moderating today's session. I do apologise for the slight delay that we've had this afternoon, but hopefully everyone can hear us clearly now. Today's webinar will first feature an update on the latest logistics data and implications for global trade. We'll then have a look at the results for TI's February Logistics Confidence Index and then finish with some discussion of cross-border e-commerce opportunities. The webinar should last a maximum of 30 minutes. Our panellists today will be Zahra Ward-Murphy, Strategist at Absolute Strategy Research, and David Buckby, Economist at Transport Intelligence. Just a little bit of housekeeping before we start. Please be aware that there are a mix of ASR and TI clients listening today. And second, while some specific companies may be referenced, you will not be exposed to any material non-public information. I should also just mention that a replay of the webinar will be available to download on both the TI and ASR websites following the call. And now, without further ado, I'll hand over to Zahra to begin her presentation.
Thanks very much, Lisa. So in the last webinar, I delivered a message of continued strong momentum in trade indicators such as air freight and container shipping. And my message today really remains positive, both on the momentum and the near-term outlook for trade. I'm a bit more cautious, and that's because some growth rates, particularly out of Asia, did slow significantly in January. But I do think that this will prove to be predominantly due to the timing of China's New Year holiday. We look through this, the narrative to me still appears to be a positive one, and the outlook for trade in coming months does look encouraging. If I start by looking in a bit more detail at the European air freight data, so last month I noticed some fairly strong growth rates in early European air freight data for December. We've now got all our regional proxy components in for December, and our indicator actually rose by 8% year on year. Spain, Italy, and Schiphol in the Netherlands all posted double-digit air freight growth in December. Paris air freight was up 7%. Germany overall was up 7.5%. If we look at this slide on screen now, we see that this actually took our European air freight proxy to yet another all-time high. If we look at the thick gold line, which is a 3-month moving average, we can see that the level of freight is now more than 5% above its 2011 high. This is a time when global activity and trade was really recovering post the recession, and businesses were restocking their supply chains, and more than 10% above the 2008 high, which was really the end of a strong period of trade growth before the recession. For January, the European air freight data that we've got so far suggests that growth did remain quite strong into the beginning of the year, albeit that there appears to have been some moderation in the pace of growth versus December. If we look at the table now on slide 6, and we focus here on the last column on the right, which shows the latest data, we see in January Frankfurt air freight moderated a bit to 6% from 8%, Schiphol 7% from 10%. Both Heathrow and Liège in Belgium saw growth of 5% year on year. Spain, though, is still seeing very robust growth. It was 11% year on year in January, and that's the 6th consecutive month of double-digit growth from this market. Now, Frankfurt noted that the cargo sector started with a dynamic growth rate in 2017. It said this reflected stronger international trade. They had the 3rd highest January on record. That's after 2008 and 2011, those 2 years I've already mentioned as being the periods of strongest trade growth in the past decade. At Frankfurt, the inbound growth at 7% year on year was slightly stronger than the outbound growth, so more freight coming in than out. Frankfurt suggested that due to the Chinese New Year, some shipments into Frankfurt may actually have been brought forward, and this resulted in an 11% growth in air freight inbound from China and Hong Kong. The freight outbound, the other way to China and Hong Kong, was actually down year on year. But what was positive was outbound freight to other North Asian economies. And so I take that as quite an encouraging sign in terms of underlying strength if we look past the Chinese New Year effect. Frankfurt did also note the devaluation of the euro was boosting industrial activity in Germany. Turning now to Asian air freight. If you joined us last month, you'll recall that I was talking about an expected 10% year-on-year growth rate in our Asia proxy in December. In the end, it did actually grow faster than this. The outstanding Tokyo data came in really strong at almost 15% year-on-year. So Asia air freight, according to our proxy, therefore rose 12.5% year-on-year in December. If we look on slide 7 on screen now, as with Europe, we see that strong growth in Asia took our proxy in level terms to an all-time high in December. That's focusing again on the thicker gold line. And here we're talking about activity which is 15% above the 2011 high and 30% above the 2008 high. So these are figures, I think, which, at least in this segment of trade, in air freight, do appear to contradict the ongoing deglobalization narrative that is prevalent at the moment. In terms of the January data for Asia air freight then, the data that we have so far do suggest a much more significant slowdown in Asia than in Europe in January. If we turn to slide 8 and look at this table and focus again on the right-hand column of the table. If we can go on to slide 8, Lisa. That's great, thanks. In January, China's still yet to report overall, but Shanghai air freight growth, that slowed down to 5% from 12% in December. Taiwan air freight growth also slowed to a similar pace from a very strong December number. Korea air freight still rose a fairly robust 8.5% in January. That's down a little bit more modestly from the 13% rate that we saw in December. Again, however, one big issue that we've currently got with all these data, particularly the Asia data, is the issue of the Chinese New Year. So this year it was earlier. It started on the 28th of January rather than the 8th of February. So this suggests fewer working days in January this year compared with January last year. That should depress growth rates in this January's data, but then we should have the reverse effect and see that bounce out in February. I must say it's not always quite so straightforward, because some of the data and some of the commentary does suggest a rush to get goods out before the new year, which does pull some shipments forward. But I think that the predominant impact, particularly with regards to the Asia data this year, is going to be to depress these January numbers. So overall, our global air freight indicator rose 9% year-on-year in December. IATA, the International Air Transport Association, measures air freight on a slightly different basis. They do it in freight ton kilometers, so the freight times the kilometers flown. But anyway, they had a similar sort of growth rate of 10% year-on-year in December, so still very robust. They acknowledged much stronger air freight in the second half of last year, coincided with stronger export orders. And they said, more generally, they also saw a pickup in sea container activity. Looking ahead, they are a bit cautious. They're not really sure whether the recent upturn in air freight is the start of a sustained period of stronger growth or just what they call a potential false dawn. On the negative side, the two things they're worried about really are the weakness in the wider world trade indicators. I've discussed that before in terms of the sort of the CPB data and the potentially the commodities data really weighing on that overall trade number. And the other thing that they're worried about is this rise in populist and protectionist political rhetoric, saying that means we have now probably passed the period of peak trade openness, they call it, and that could weigh on global trade in the years ahead. In terms of more positive opportunities for air freight, however, they did note strong growth in areas such as pharmaceuticals and also cross-border e-commerce, which is quite interesting because that's a point that David's going to pick up on shortly. If I move now to the signals from container shipping data. So last month I reported that US West Coast container ports recorded their strongest December ever. They've actually followed this up with their strongest January ever. So loaded outbound containers were actually up 17% year-on-year in January. If we look at slide 9 now and focus on the left-hand chart and the thicker line in gold again for the level of activity, we can see how outbound volumes have recovered significantly but not totally from the big decline that they saw in recent years. Loaded inbound containers were up 11% year-on-year in January. And if we look at the right-hand chart here, and again looking at that thicker gold line for the smooth level of activity, we can see the outbound volumes, a bit more volatile overall, but they are close to record highs. Moving on to slide 10, this chart here shows US inbound volumes in non-seasonally adjusted levels per year, so that we can see the seasonal pattern that you normally have in the shipping volumes. So we find that January volumes, represented by the red diamond marker on the left-hand side of the chart, were way above previous years. Now, the ports cited two factors in this. First, fuller ships calling ahead of Chinese New Year. So this is a bit of the pulling forward effect that I mentioned earlier. But second, they cited retailers restocking inventory after a strong holiday season, which I'll come back to in a second. If I turn now to Asia shipping, in previous years, so China hasn't reported December container shipping volumes. This year it has, which is helpful, but we haven't got the December from the previous year, so we can't get a proper growth rate. However, slide 11, which is similar to the previous chart, shows the non-seasonally adjusted levels of activity per year at this time for China. It does, however, suggest quite a strong finish to the year in December. But if we move now down to the table on slide 12, and looking again at the right-hand column for the very latest data, we see that in January, container shipping growth was relatively modest and fell back to just 3% year on year. Hong Kong and Singapore growth rates also fell back in line with that moderation that we've seen from China. However, again, I think the timing of Chinese New Year could be very significant here. Activity at Chinese ports will have stopped for the holidays before the end of January, and so earlier than last year. And this suggests that year-on-year growth in Chinese port throughput will likely rebound in February. Just to round off on the container shipping, for Europe, I only track quarterly volumes for Antwerp and Rotterdam, but volumes here also saw a strong end to 2016. They rose 6% year-on-year for a new high in Q4, consistent with comments from IATA and comments that we've had from Frankfurt Airport before about a pickup as well in sort of sea container shipping. If I can just come back now to the restocking point that was mentioned by the US ports, because this is important in terms of the outlook for trade. If we look at slide 13, these two charts here, and focus on the left-hand chart, we see that in the US recently, business sales, which is a broad measure of sales shown by the gold line, have been growing much faster than inventories, which is the green line. And this results in, on the right-hand chart, a fall in the red line, which is the inventory shipments ratio. So what this means is the level of inventories is falling relative to sales, or that sales are rising relative to inventories. And what this means is that the restocking story could still have a bit further to run, and that will continue to support trade growth in coming months. These are the data here for the US, not shown, but the inventory shipment picture for Japan, Korea, and the Eurozone is also supportive for trade. On slide 14, what we have here is a global proxy for the inventory versus orders situation, which is based on the PMI data components for the US, Japan, and the Eurozone. So this proxy, which is the rising gold line, is also supportive of trade growth in coming months. And this includes the flash PMIs that we had out today. They were supportive too. In both Japan and Europe, the PMI components for orders rose relative to inventories. And in the Eurozone PMI, export orders actually rose to their highest since April 2011, due, according to Market, to the combination of rising demand and the weaker euro. The Eurozone and Japan surveys also both paint a supportive picture for growth in H1, in terms of the backlog of works, in terms of capacity, and which is tightening, and in terms of buoyant confidence. So I'd like to finish now with two charts and two reasons as to why we care about all this logistics data from an investment perspective. If we turn to slide 15, in terms of the regional, equity strategy, I still think that the strongest implication is for Asia ex-Japan. Asia ex-Japan tends to outperform global equities when trade growth picks up. The recent Trump tantrum saw the beginnings of that trade pickup get priced out of the market. And whilst we have seen a bit of recovery in the regional relative, I don't think that the trade pickup has yet been priced back in. And that's one reason why I think Asia ex-Japan equities could outperform going forward. And then just lastly, if we look at slide 16, in terms of the overall equity market picture, rising trade, and particularly the upturn that we're seeing in air freight, does tend to coincide with an improvement in earnings growth. Now, current stretched equity market valuations mean that we really do need to see the anticipated pickup in earnings materialize in order to underwrite the market at these levels and to allow for further upside. The logistics data, therefore, provide macro encouragement for an improvement in earnings growth going forward, which should support the overall equity market. And with that, I am now going to hand over to David.
Thanks very much, Zahra, and good afternoon, everybody. I'll just tie in to Zahra's content by kicking off with the results of TI's monthly Logistics Confidence Index. First, though, I'll give you a bit of background on it. So TI has been running the Logistics Confidence Index since around 2013. And to construct it, we survey participants each month on the volumes they are currently experiencing relative to their expectations, as well as how they expect volumes to develop over the following 6 months. The total index covers 4 European-based trade lanes, so Europe to Asia, Asia to Europe, Europe to US, and US to Europe. And these trade lanes form 4 sub-indices from which an overall index for both the air freight and sea freight industries is calculated. So an index value of 50 indicates no change to volumes, above 50 indicates higher volumes, and below 50 is lower volumes. And if you're familiar with monthly PMI data, the Purchasing Managers Index data published by Market, then it's along similar lines to those indices. And if you'd like to see the full index report and methodology in more detail, then the link on the slide will take you through to that if you go to the TI or ASR website and look for the slides there after the call. So for now, what does the Logistics Confidence Index data show for February? Well, broadly, we're seeing a continued positive start to the year for the overall Logistics Confidence Index, and that's the average of the air and sea freight indices. In February, it increased by 2.6 points month on month to 54.6, so we're firmly in expansion territory there. Also, compared to a year ago, the index is up by 7.4 points, so plenty of reason for optimism. The improvement in the overall index score was, again, primarily driven by improvement in sea freight, just like January. The sea freight index recorded a month-on-month gain of 3.6 points to 56.6, and Asia to Europe again saw particularly impressive results. As for air freight, results are trending upwards too, though more modestly, with an increase of just 1.4 points to 52.5. So I think really our primary research here is echoing Zahra's findings that freight volumes appear to be on a bit of an upward curve at the moment. Just one last thing on the Logistics Confidence Index. Each month we ask participants a one-off question, and for this month we asked whether after 4 years of decline, global container shipping rates would increase in 2017. And the results of that poll were that 51.6% of respondents said that rates would indeed increase. And as I argued in last month's webinar, there are some pretty good reasons to hold that view. So factors such as higher expected fuel prices and better commercial discipline, for example. That said, 34.4% said they expected rates to remain basically flat in 2017, while just 10.9% expected rates to fall. Now, changing track a bit from a macro discussion of trade to more of a micro view, if we move on to the next slide, I'd like to spend the remainder of the webinar talking about cross-border e-commerce and the opportunities that it offers. And this slide just highlights what I plan to talk about. So first I'll give you an overview of the market size. Then I'll move on to talk about some of the key fundamentals of the market, so things like supply and demand, what the main goods traded are, and so on. And then I'll move on to an assessment of the logistics side of the cross-border e-commerce market, so what the opportunities are there, and then finish up with what we actually know about the e-commerce logistics market overall. So moving on to the next slide, and I'll start with how large is the opportunity in cross-border e-commerce. Now there's a few estimates out there, and the most recent one I've seen is from a DHL report on cross-border e-commerce that was published very recently, in fact. And the link to it is on the bottom right of the slide there, so you can look at that at your leisure after the webinar. But the estimate in the report states that cross-border e-commerce sales were about $300 billion in 2015, accounting for approximately 15% of global e-commerce sales. And by 2020, they expect that share to rise to 22%, as you can see on your graph there. Another estimate of the size of the global cross-border e-commerce market by Accenture and Ali Research, which is Alibaba Group's research arm, that suggests that the market is expected to increase in size from approximately $230 billion in 2014 to $1 trillion in 2020. So the DHL figure and this figure are broadly in agreement, I would say. And very quickly on growth rates, the consensus seems to be that cross-border e-commerce will grow at roughly twice the pace of domestic e-commerce over the next 5 years or so. And it's something like a compound annual growth rate in the range of 25% over that period. Now, if we move on to the next slide, this chart gives us an idea of cross-border e-commerce trade flows. Now, unfortunately, in the DHL report, where this graph has been taken from, they only provide a concrete geographical breakdown with respect to high-value transactions only. They define high-value transactions as those over $200. However, they do give some indication of the regional split for all cross-border e-commerce, but I'll come back to that later. But at least for high-value items, origin and destination regions account for about the same share of supply and demand. So, for example, if you look at the graph, that's exactly true for Europe. It's responsible for both the import and export of 35% of global high-value cross-border e-commerce. Asia's a little bit different. It imports 32%, but exports 37%, so there's a bit of an imbalance there. As for all cross-border e-commerce goods, not just high-value goods, the DHL report appears to indicate that the regional split isn't too different from what you're seeing in front of you. The main difference is that Asia accounts for a higher share than it does for just high-value goods, both in terms of supply and demand. If we move on to the next slide and drill down a bit and look at things on a country level, you can see that demand is more fragmented than supply, with the US, UK, and China accounting for close to 30% of all global high-value demand compared to 60% of supply. And the main reason for that is that other markets like Australia, France, and Canada play a more significant role in demand. Moving on to the next slide, which is about the main types of goods involved in cross-border e-commerce. The evidence suggests that electronics and fashion are the largest and most mature verticals, but other sectors are in fact growing faster. So if you look at consumer surveys, they indicate that across regions, fashion and electronics are indeed the dominant product categories. And you can see on the graph that those surveyed, however, are less confident about their growth prospects, rather. So as you can see there, fashion and electronics sit at the bottom with 17% and 23% growth rates, whereas a higher proportion of retailers involved in other sectors are quite a bit more confident about seeing significant increases in their cross-border revenue shares. Now if we move on to the next slide, and this is really where I start to stray into the logistics side of e-commerce. So what are the underlying economics of cross-border e-commerce? Well, intuitively you might expect that e-commerce generally would adopt an increasingly localized or perhaps more domestic business model over time. And that's because you would think that there's higher cost efficiencies from faster shipments over shorter distances. So why then do many e-commerce giants who have extensive networks already have substantial cross-border sales, if that were to be the case? Well, it's thought that this is mainly driven by the enormous range of products available. So if you imagine trying to facilitate localized fulfillment and last mile delivery of every single product everywhere, there would be quite a significant percentage of goods that are quite slow turning inventory sitting everywhere. And it turns out that that, as an operating model, is far costlier relative to shipping a certain amount of orders cross-border. And when cross-border consumers want rapid delivery, premium shipping options are still available. They are offered for a surcharge, but really that's the best of both worlds for e-retailers, because they can keep their customers happy and have a more cost-effective operating model. So the economics dictate really that cross-border e-commerce is very much here to stay. That said, a survey from e-commerce Europe called Barriers to Growth shows that 44% of companies selling abroad view cross-border logistics and distribution as a difficult barrier to overcome. And in addition, 15% of companies that do not sell internationally refrain from doing so due to excessive transportation costs. So there are definitely perceived logistics barriers there that appear to deter potential cross-border sellers. And finally, just to give you a bit more of an overview of cross-border e-commerce, it's just worth highlighting that cross-border e-commerce volumes are currently dominated by Alibaba, Amazon, and eBay. And according to the IPC, the International Post Corporation, these firms together account for 65% of cross-border e-commerce, so it's really quite consolidated. So moving on to the next slide, with all that I've just mentioned so far in mind, really, what are the opportunities then in cross-border e-commerce logistics? Well, I think fairly obviously the bias of logistics costs between the warehousing side and the outbound shipping side, it's going to be heavily tilted towards outbound shipping, certainly compared to domestic e-commerce operations. And that's especially true when transactions are high value. And DHL states that around 20% of cross-border purchases are worth over $200. And as you would imagine, that's a far higher share than in domestic e-commerce. They also say that such shipments provide especially high profit potential for them, and that's because they're more likely to be premium, time-definite international shipments. And according to them, every 10th US dollar of cross-border e-commerce revenue is made through an international time-definite premium shipment. So there's clearly a quite substantial market opportunity there already for the express integrators of DHL, FedEx, and UPS. For intra-European shipments, there's also quite clear significant market opportunity there for ground-based express providers like the French Post Office's subsidiary DPD, for example, or Royal Mail subsidiary GLS to achieve significant growth too. If we move on to the next slide, you have seen this graph already earlier in my set of slides. It was the one right at the start of my presentation. I'm showing it here again for reference because if you want to figure out how large the cross-border e-commerce logistics market size is, one thing worth thinking about is whether it's likely to be around 15% of the total e-commerce logistics market, as was the case in terms of overall e-commerce sales. But I'm sorry that I'm going to have to disappoint you all a bit here because we don't really know the size of the global cross-border e-commerce logistics market. And that is because there is not enough visibility, in my view, on logistics costs as a percentage of sales data associated with cross-border e-commerce specifically. But if we move on to the next slide, what we do have is a pretty good idea on logistics costs as a percentage of sales data for a number of online retailers generally. And that's helped us to estimate e-commerce logistics market sizes by region and country in our latest report, Global E-commerce Logistics 2017. So just to give you a bit of an idea, logistics costs as a percentage of sales varies between around 5% and even up to around 40% for some companies, depending on a range of factors. And we've looked into this in some detail, and we've identified how logistics cost as a percentage of sales tends to vary by vertical sector. So, for example, how is a general goods retailer like Amazon or Zalando, the big European player, how are their logistics cost structures different from a fashion retailer like ASOS, or an online grocery retailer like Ocado or HelloFresh, for instance, or even a luxury goods retailer. We've also looked at how logistics costs vary by retail channel. So what are the typical differences between a pure play online retailer compared to a multi or omni-channel retailer like Tesco or John Lewis, for example, or even compared to an online marketplace like eBay. And also, what are the main differences between developed and emerging markets? So how does the trade-off between higher logistics efficiency in developed markets versus lower labor costs in emerging markets play out? How does that trade-off affect logistics cost structures? So really to finish off, I'd just like to say we don't have all the answers around cross-border e-commerce logistics yet, nor even e-commerce logistics generally. But what we do know is that it's a rapidly expanding market, and that's certainly going to be the case for the foreseeable future. It presents great opportunities for many logistics providers, particularly for integrators such as DHL, UPS, or FedEx, especially if they can increasingly sell their time-definite premium services. And lastly, as well as the report providing plenty of data and
I do apologise, we seem to have a little problem with the sound there, so I will cut in over Dave and just say we will end the webinar there, and thank you to Zahra and David for your presentations, and thank you everybody for attending. Our next call will be held on Tuesday the 28th of March. Thank you. Bye.